This is the Debunking Economics Podcast with Steve Keen and Phil Dobbie.
The Archives.
Episode 127. Who's next for a debt crisis?
Welcome to the Debunking Economics Podcast with Professor Steve Keen. I'm Phil Dobbie, and today, where will the next debt crisis be, and when will it start, and what factors will lead to it? Steve Keen says it's already on the cards for Australia, with house prices there already on the slide, but where next? And will it really be a crisis? Or can the economy absorb these falls in house prices? After all, Australia doesn't seem to be rushing to a recession just yet. So who next for the debt crisis? That's this time on the Debunking Economics Podcast. Yes, who will the next crisis hit first? But before we do that, first of all, Steve, I mean, we had an economic crisis in 2008. It hit just about everybody. But was it all that bad? I mean, it certainly wasn't the Great Depression, was it? We didn't have, as we did in the Great Depression, people selling apples to try and make a living on the streets of New York and try and support themselves. We didn't have half the children in the United States not having enough food, housing or medical care. It seems, despite this crisis, which as we are told it was, we were still buying our iPhones and our flat screen TVs. We didn't have any of that desperation that we saw in the Great Depression. So was it all that bad? Was it really a crisis?
Well, we did have that desperation in parts of southern Europe, because that's not to be forgotten. We've still got it happening in terms of countries like, obviously, Greece. And to give you an idea, like Spain is like at the moment, Spain is one of the ones that had a serious level of unemployment. It hit virtually 30% of the population. That's still running at about 20% unemployment. And
but we think of the United States as being the epicenter of all of this, though. And 10 years on, inflation's low, unemployment is very low, share prices are up. I mean, people would say these are good times. Not as good as it gets, but not that bad either.
Well, I want to make the contrast as to what did America do differently to mean that it didn't end up in the situation that Portugal and Greece and Spain ended up in.
Well, it wasn't in the euro.
Pardon?
It wasn't in the euro.
Basically, it's the euro, and the reason for that is that it isn't just the currency itself. It's not a bad piece of. It's actually a better looking piece of art than the American dollar. I mean, give me the euro any day as a piece of art. But the difference is that the American government can produce the dollars it needs for expenditure, and its government deficit in the immediate aftermath of the crisis, so 2008, 2009, when Obama came to power, the deficit then was running at 15% of GDP. Now, the euro, the Maastricht Treaty, puts a limit of 3% of GDP on the level of government spending in terms of an increase in the government debt in any 1 year. And that was supposed to be fiscal responsibility, supposed to, it was actually called the Growth and Stability Pact. It gave it shrinking economies and instability. So the difference really between the euro and America today, and then America today and America back at the time of the Great Depression, is simply the size of the government sector. Because if you go back to when the New Deal occurred, we get taught the New Deal in history, those that still learn history, and we know how much that was some Austrian commentators will say that actually made the Great Depression last longer. But I mean, I'm going to leave that particular claim aside for a moment.
But we bought our way out of it, in effect, didn't we?
And we were. But the Great Depression, the New Deal, it's very high. The largest amount of money being added to government debt by the New Deal was equivalent to 5% of GDP. Now we know about things like the Hoover Dam project, the Tennessee electrification. The building of the road system across the states, a lot of it began under the New Deal. So it was huge in terms of industrial projects and so on. But in terms of the percentage of GDP, it peaked at 5% of GDP, whereas Obama's stimulus was 15%. Now, why did it not seem that much larger? It's because if you go back to the Great Depression, government was about 1/3 the size of what it is now. So a 5% of GDP stimulus, which is what the scale of the New Deal reached, was something like half of total government expenditure, whereas 15% was substantially less than half of government expenditure. Government's gone from about 10% of GDP, in other words, to about 30% now.
Right.
And what that means
So you're saying that the crisis wasn't that bad because we've got a bigger government sector in that case?
Yeah, but what you get is when private sector spending goes down, government sector spending goes up because tax revenues fall and welfare payments rise. And of course, back in the Great Depression, you didn't have unemployment benefits. So the fact that people became unemployed didn't mean that there was government giving them money to spend. It meant they were out in the streets scrounging, as you said. And that's the fundamental difference. So fundamentally, what you've got is, in the analogy I like to draw on this front, is that the government's like an air conditioning system. And if you have a small air conditioner and you get Arctic conditions outside, tough luck, you're going to get cold. But if you have a large air conditioning unit, and the temperatures drop, your air conditioner goes gangbusters and you don't feel much of a drop in temperature. And that is fundamentally the role the government plays in the economy. And that's why, particularly the scale of the rescue after the 2008 financial crisis, that's why we didn't have the extended period of private sector deleveraging we saw during the Great Depression.
So that's a good thing then. I mean, if we ignore the constraints that are placed on countries by the euro, which is a separate discussion which we've had, but we'll no doubt revisit. The fact that, if we have in inverted commas, crisis, it's not going to be that bad because governments can step in. It's just a question of foreseeing it and making plans on how you're going to cope with it. You're probably not going to stop it, but it's knowing when it's coming.
Well, the other trouble is that you still get one of the side effects of the scale of the rescue is that the level of private sector deleveraging that occurred was nothing like what we got after the Great Depression.
Yeah.
So if you look at the Great Depression, the level of private debt exploded during the Great Depression, not because people were borrowing money, because the rate at which they were paying down debt was exceeded by the rate at which GDP itself was falling. So right from 1929-30, you had people reducing their debt, which means they're taking money out of their bank accounts and sending it to the banks, which is reducing money in circulation and reducing demand. But the GDP was falling even faster. So with the rate of private sector deleveraging peaked between 31 and 33 at about 10% of GDP every year, which is huge. But at the same time, GDP was falling by 25% per year, which is gigantic. And consequently, the debt ratio rose. Now then, from that point on, 32, 33, you had a substantial fall in private debt. And eventually, after the Second World War as well, the level of private debt compared to GDP was down by 75%. So you went from about something, when I normalize the data, I think I'm not looking at the numbers right now, but it's something of the order of debt falling, say, 120, 130% of GDP down to 30%. Right, a gigantic fall.
Which is very different to now. So, for example, in Australia, we just haven't seen any deleveraging at all. Australia's just carried on willy-nilly as though there wasn't any financial crisis because, of course, China kept on buying from them. So they were sort of excluded from it a little bit. But the deleveraging hasn't been that strong. I mean, the US saw a little bit. It seems to have bounced back up again now. The UK's, most places in the world, it's fallen a bit, but not a great deal.
Well, in fact, in Australia's case, it's gone up.
Yeah, that's what I'm saying. It just didn't stop. Yeah. Exactly. Yeah, that's
right. They basically borrowed their way through the crisis, which means, of course, they've now got a bigger overhang of debt. So America went from about 170% of GDP as its maximum private debt level to 150%. Now it's rising once more. The UK went from 195 to 170. It's rising again. So what you've got is a huge fall in demand when it first hit. But then the extent to which demand fell being attenuated by the government rescue kicking in, large amounts of money turning up, interest rates being dropped to zero, people spending, therefore not having the same pressure to reduce their debt levels, and therefore you got a revival of credit in those economies. But the ones that avoided the crisis completely, like Australia and Canada, did it by just going gangbusters for borrowing. So if you look at Australia's debt level after the financial crisis, it was about 180% of GDP. This is using Bank of International Settlements figures. It's now 205%. So we've actually, the countries that avoided the crisis back in 2008 have done it by getting more levered still.
Is there a danger, though, in taking the figures for one country, that debt to GDP ratio in aggregate? Because, I mean, countries can be very divided. So if we look at New Zealand, for example, we know Auckland has very expensive house prices. In other parts of the country, maybe less so. So it might be an Auckland phenomenon rather than a countrywide phenomenon, for example.
Well, the overvaluation of real estate is worse in the major capitals than it is in the provincial cities. That's true. But the one thing I'm looking at is the credit money creation that's going on as a result of private borrowing, and this is why I identified the cause of a crisis as having too high level of private debt. With too high an increase in that level of private debt, because the increase in private debt generates credit, which people spend. So your total demand is the sum of the turnover of existing money plus credit. Now, when plus credit, as it was in America's case, is 15% of GDP, and then 2 years later it's minus 5%, you've got a 20% of GDP turnaround, a drop in demand in a matter of 1 or 2 years. That's what causes a crisis. But most economists focus on what you're talking about at the moment, which is who owns the debt, what's the distribution, et cetera, et cetera. My answer is it's the volume, stupid. And if you forget about the volume, then you miss these effects, because the distribution of debt is effectively a second order thing. The first order is the scale of debt and the scale of increase, which gives you credit demand and can therefore give you everything going from boom to bust overnight.
So what breaks it then? If it keeps on rising, whatever rate, what is the breaking point? You mentioned three variables in your book, in your latest book, about a tendency to crisis. One is that private debt to GDP. The other is wages as a proportion of GDP, and the other one's the unemployment rate. The unemployment rate, of course, is pretty low right now. So tell me how those other two variables get entwined in all of this.
Well, that's a very complex question, and quite literally complex, because it's explaining a complex system. But what you have in capitalism is fundamentally a monetary system, and the reason mainstream economics doesn't know what happens in capitalism is they leave them with money completely out of their thinking. So and this comes from their bias to trying to derive the economy from what they call first principles of their model of microeconomics. Now, the micro is nonsense. That's the major part of debunking economics, is devoted to showing that their arguments about what happens at the micro level are simply wrong. But that's their obsession, trying to derive macroeconomics from micro. My point is to go the opposite direction, and so let's derive macro directly from macro and actually take macroeconomic definitions. So the three that I take, which I think are absolutely crucial, are the employment rate, the number of people with a job divided by population, and that gives you a measure of just how much of your productive capacity you're actually using. The wages share of GDP, that tells you how much income is going to one of your three major social classes, workers, the other two being capitalists and bankers.
Right.
And the third is the debt level, which tells you how geared the economy is. And that's the level of private debt divided by GDP. So you put those three together, and you get a model which talks about the distribution of income, which is what's left out of mainstream economics. Again, they ignore the distribution of income. They have this idea of a representative agent who's supposed to be a worker capitalist who owns all the firms and works in all of them and pays himself a wage depending, and on it just becomes a piece of lunacy.
Yeah.
I'm saying let's start with workers, capitalists, and bankers.
I know you're saying it's a complex system, but I can see some of the linkages there seem a little bit obvious. So if you've got a high proportion of wages are going to the workers rather than to any other sector, then you presumably going to borrow less. You're less need to get into debt. Whereas if a higher proportion is going to the finance sector, then you're more likely to need to borrow. And in fact, as you do borrow, that means more money is going to go to people in the financial sector.
And that's basically what happens over time. So what you have is, if you have and the whole thing's driven by investment. So if you have capitalists' desire to invest depending upon the rate of profit, then a high rate of profit means they're more willing to invest, which is a good thing. This is one of these ironies. It's not a bad thing at all. But if they're wanting to invest more and they've got to borrow money to do it, then of course that higher willingness to invest leads to a higher level of borrowing, and the higher level of borrowing over time, because the money is being borrowed to be invested. And I'm looking at genuine investment here rather than the Ponzi scheme stuff we get stuck at in the actual real world. But that means you've got more productive capacity, you hire more people, whammo, workers can demand wage rises, and at the serious end of the spectrum as well, raw materials producers, like the OPEC, for example, can demand high and get higher oil prices. That changes the distribution of income. So the level of profit capitalists get in the boom is not as high as they thought they were going to get, because they're paying more to workers, more to raw materials suppliers, and more to bankers. The investment drops off, the economy slows down. You then have a slump where the raw materials and wages fall relatively. You pay down some of the debt, but you get back to the point where you have the same level of rate of profit that first of all set the boom off, leading capitalists to want to invest again. Off they go, borrowing money to do it. And you start with a higher level of income going to the banking sector than the previous boom, and a lower level going to workers. So even though in my model, this is me explaining verbally my model now, even though in my model, capitalists are the only ones doing the borrowing, and they're doing it to borrow money to build factories. It's the workers who pay for it out of a lower wages share. And so it's a three-way equation, not a two-way equation, which is, if neoclassicals ever think about the distribution of income, they think workers versus capitalists. They don't think workers and capitalists versus bankers, which is what actually turns up in my model.
But how does that work in Australia's case then? Because Australia has this very high debt to GDP ratio. It's got unrealistic house prices, so people are borrowing a lot to buy their houses, and yet their wages are still high. So money might be going to the finance sector, but people are still doing well. They've got some of the highest wages in the world in Australia.
In the world you do, but in terms of distribution of income within each country, it gets biased towards the finance sector and away from the workers. So that's the real danger, because this can go on for a while, but what you get each time is a boom and bump in the level of private debt. So I'm looking at the private debt data for Australia right now, and you see back in the 1960s, it was about 50% of GDP. You then had the gradual increase until the boom under Hawke and Keating, when it hit about 125% of GDP. Then it dropped in the recession of the 1990s to about 110%. It then rose during the GFC to about 180%. It fell in the aftermath. Now it's 210%. So each time that's happening, you're getting a ratcheting up of the amount of income, the claims the financial sector has on the real output of the economy, and that claim comes at the expense of workers.
Right. So average wages look good because the finance sector is paying themselves more and more. So we presumably are getting a bigger wage divide in that case.
Yeah, that's right. You look at I'm still the most, for me, this is talking the UK, but I think it'd be comparable in, places like the so-called millionaires factory of Macquarie Bank. That I met a character in the finance sector here in the UK when I first arrived, and his wife turned up to the dinner, and in a conversation revealed that her salary when she did work in the finance sector was £750,000 a year. Now that would turn up as a wage. Now that was roughly 10 times what I was earning to be a professor at Kingston. Yeah. So when we record the data and record the wages being paid in the financial sector as part of the overall wages bill, we're fundamentally distorting our view of what's happening in distribution of income.
Right, but how does that happen? So you've got a small number of people who are earning so much money. They're making it in, primarily in housing loans. Those housing loans have to go to everybody else. How is everybody else affording it? Well, the answer obviously is that they ratchet up more private debt, but there's still standards in terms of that they have to meet to take out those loans. And governments have been trying to tighten those regulations up to ensure that housing loans are affordable. How does that model continue? Is that your point? It will break at some point. Yeah,
it doesn't continue because it's all based on myth. And this is the wonderful thing about the. I'm sure you've been following it about as much as I have. The Royal Commission into Misconduct in the banking and financial services sector in Australia. And my absolute favourite document from that, although I'm sure I can find better, but this one's pretty damn good, was the National Australia Bank's table. It's living expense calculator, as it's called. And if you take a look at this thing, which I've linked on one of my most recent blogs on the website, on the Patreon website, let's say, it tells you that a couple earning $60,000 a year, which, like in American dollars, that's about $40,000. That company is earning $60,000.
That couple,
a couple before tax, who'd be paying no more than there's a maximum $20,000 in tax, probably far less than that. So let's say they're taking $45,000 as their income level. This calculator presumes they're spending $24,000 a year, living on $24,000, and therefore have $16,000 a year they can use to take out a mortgage. Now, that doesn't quite give you the scale of the ridiculousness of this document. My favorite one that does is what they're saying for a couple earning 400,000 Australian dollars a year or more. Now, you and I both know that's an extremely princely sum. That's, each of them earning 200,000. So they're earning 400,000. That would give them a disposable income of about $250,000 a year, which is, say, $20,000 a month. This calculator presumes they're spending less than 4,000.
Yeah.
That is
there will
absolute total bullshit.
Fine dining, I'm sure, every night if they're on that money.
We have Ebenezer Scrooge married to a Swabian housewife. That's this calculated vision of the consumption of the average Australian. No, I'm sorry, there wouldn't be a Prada shop in the country if that were true. It's it's total farce. And people who are reading off these numbers and working out what people can afford, you'd have to be stoned on a variety of substances just able to read off the numbers. But for God's sake, don't do any calculations to work out what they imply. Just to go a bit further here, the same number, a single person earning $400,000 a year or more, therefore having a single individual disposable income of over $20,000 a month. The calculator presumes that person was spending $3,041 a month. Now, everybody you know is Ebenezer Scrooge on this thing, but even better. What's the cost of a child? Now, how many kids have you got?
I've got just the two that I know of. And shitloads is the answer to that question.
Well, they're
not even teenagers yet.
No, you made a big mistake by moving from Australia to the UK because, according to this calculator, it costs you to raise a child. I'm not talking, pocket money. I'm talking education, transportation, iPhone. Okay, £7 costs you $7 a week.
Right, well, that would be interesting, except 1 in 3 kids in Australia now go to a private school, and private schools are about $20,000 a year.
Yeah.
So,
magically, it turns into $7 a week.
And that's before they eat or wear clothes or go on holiday or anything like that.
Yeah, now, this is fraud. There's no other way. This is absolute, total, outright fraud. And it's disguised because it's done in a neutral little fashion. Just read off the numbers. For God's sake, don't calculate what they mean. So just give me an idea. Couple on $400,000 a year or more gross salary, which means $250,000 per year in Australian dollars, which is about America list is about $180,000 a year. Let's go back to the Australian numbers just to make the comparison easy to keep a track affordably. So you're earning $400,000 before tax. You're supposed to be spending less than $4,000 a week. If you have a child, your spending goes from $3,716 to $3,924 a month. So that kid is costing you about $200 a month to support. What absolute crap!
Yeah, well, if you don't feed them. But look, the housing affordability is an interesting thing, isn't it? Because you would have thought, okay, we know Australia's got a housing affordability issue, and we know that is being driven by debt, and that is, as you're saying, it's because of the unscrupulous activity of the banks that just aren't being realistic in the loans that they're issuing. And yet, by your own, looking at some charts, from a blog on Patreon, you've indexed real house prices as 100 in 1975. Australia moves to just under 300 now. The UK is about 360. So that would mean house prices have skyrocketed more in the UK, despite the level of debt that we've been seeing in Australia. How does that happen?
Because basically this is driven by this is the complex
Russian
answer
bias.
once more. It's driven by the acceleration of mortgage debt. And you can have this ironic outcome of, and particularly as obvious in the Irish data, of course, you can have virtually falling level of household debt, but accelerate it's falling at a slower rate. And that ends up with an acceleration over time. So this crazy chart, that's figure 1 on the Australian housing, they call it Australian Housing Bubble Pops blog. You have Irish house prices rising from an index pretty much 100 in 1995. It's 120, but it's pretty much like I started the data from 1975. So the Irish house prices in 1985 were still about the same in real terms as they were in 1975. So in 1985 and 2005, they increased by a factor of 4. And when you take a look at what the hell was happening at the level of Irish debt at that time, nothing was happening. Well, there's unfortunately, no Irish debt data, at least published by the Bank of International Settlements before 2002 or 2003. But at that stage, household debt was 50% of GDP. That's 2003. By 2010, just moved 7 years, it was 120% of GDP, and now it's back down to 50% again. So look at this huge pimple of Irish debt rising and falling. The behaviour of house prices has been since 2003 to virtually double, then to fall to about 1.8 times what they were back in 1975 by 2012-13. And now they're back up again to about 3 times what they were. So the prices have risen while household debt's been falling. And you look at it, and that's a paradox. You think, how the hell can that be explained? It comes down to the relationship between the flow of demand and flow of supply, and the flow of demand for new housing is fundamentally new mortgage debt divided by the price level.
Interest rates have got a part to play in all of this, though, haven't they? And they're determined.
Yeah, they do. Well,
in part, they're determined by central banks. Obviously, they're determined by what banks, high street banks, feel they can get away with. But also, obviously, the cost of that borrowing is determined by central banks. They look at inflation and employment. Both are low. So if inflation is low, then if people are carrying too much household debt, that leads to low inflation, doesn't it? Because they think they can afford to buy less, so GDP is constrained. Therefore, central banks go, okay, well, we're not going to push interest rates up too much. So I guess that sort of makes the situation worse in a way. It
encourages people into the volume of debt. And this is one thing I identified in Australia back before the crisis.
It perpetuates it.
Pardon?
It perpetuates it because it makes it takes the bad situation where people have got so much debt, therefore they're not borrowing, therefore interest rates are low, therefore they borrow again.
Yeah, and what that gives you, while that continues happening, you get more demand coming out of that extra credit people are taking out, but you're getting squeezed into a corner. And I show this on a rectangular hyperbola graph. I'll have to reproduce it for the Patreon blog at some point. But what I had was, if you look at the overall level of debt service, it's a function of the level of debt and the rate of interest, and then you can draw a rectangular hyperbola showing, let's say if you're paying say 10% of your income as debt service, that can be because your debt level's 1,000% of GDP and the interest rate is 1%, or it can be because your debt level's 100% of GDP and the interest rate is 10%. You've got this trade-off between the two, and what happens if you have falling interest rates? Then that enables people to take out more debt, and the overall debt burden remains constant as interest rate falls, but you finally get to the point where you owe an absolute fortune. And then even if the rates are low, you look at the amount of debt you've got to take out to get into the housing market, and you think, no thanks, I'm not going to leverage my income by a factor of 10, which is what's actually ultimately required to buy a property. So the demand disappears. And when it does, that credit demand you've been relying on suddenly evaporates and down goes your economy. And that's the situation Australia is finding itself in right now.
Right. And the US is not. I'm just wondering whether historic bank lending rates have had something to do with this. Forget the interest rates from the central banks, because if you, just looking around just before we started talking, I went to see how much it would cost me to take out a loan in various countries. The best loan you can get in Australia is around 3.9%, the interest rate. It's about the same in Canada. You can get it for 3.6% in the UK. In the United States, you'd be struggling to get it for more than, for anything less than 4%. And even then, you've got to lock yourself in for a long time. Whereas in the UK, everyone sort of like moves their mortgage every year almost to get a better deal. But 4% or more locked in is the US experience. So it costs more to borrow money in the United States right now. And is that part of so the banks presumably are behaving themselves a little bit more?
No, in fact, you get right about that point about the interest rate, because what's actually happening now, and this is why I expect a slump in America in 2019, possibly 2020, is that because the people managing central banks do not recognize the importance of either private debt or credit, they are simply looking at their models of the economy. And back to a little earlier conversation when I was verbally describing how my model functions, that's what I was literally doing. I was telling you what happens in the mathematical model that I've built of the capitalist economy. They do exactly the same thing. Now, my mathematical model includes a level of private debt. Theirs does not, because according to their logic, credit plays no role in aggregate demand. It simply distributes spending power from the borrower to the saver, and from the saver to the borrower when it's going up, and from the borrower to the saver when it's going down, and the two cancel out. So they leave it out of their picture, and all they're looking at is, they've got this equilibrium where the economy is in long-run equilibrium when the rate of inflation is 2%. The rate of economic growth is 3%, and the rate of interest is 4%. And that's the magic spot they think they're heading towards. Now, what they're doing by putting the rates up towards 4%, and of course, you're talking about mortgage rates.
Yeah, they're anticipating where the central bank's going to go.
That's right. The central bank is heading towards 4%. When you hit 4% mortgage rate, and you've got a debt level of 1.5 times GDP, which is America's case right now, then that means fully 6% of GDP on average, or like a minimum, because that's mortgage rates are lower than business rates. 6% of GDP is going to the finance sector. Yep. Now, at that level, that's taking a whack out of ordinary workers' pockets. It's taking a whack out of capitalist profit as well. At that point, people start thinking, I'm not going to take out that housing loan, or I'm going to pay off some of the debt I've got. And what you see is an unexpected, inverted commas, decline in demand for housing. And that's what's happening in America right now. We're seeing a dramatic fall off in demand for new housing. So what that can lead to is the private sector goes from leveraging up, which America's been doing for a while now, to deleveraging. And then, bang, you'll go back into another slump again.
But, is it a crisis? Because, which is, getting back to my first question. So if we look at what's happening in Australia right now, it would seem that people have reached that point where they say, look, this is ridiculous. We can't afford to buy anymore. We certainly can't afford to buy at these rates. Sydney house prices have fallen as a result, just under 10% since the end of last year. And there's quite a few commentators, not just you now, saying, well, actually, maybe it's got another 10% to go. Maybe it's going to be 20% down as a result of all of that. And maybe that's why Australian GDP is down, but Australian GDP isn't down a great deal. It's still growing at 2.8% a year. So this is a country a long way from recession. It seems a long way from crisis proportions. It seems to be able to suck up this fall so far.
The last figure just came out earlier this morning, and it's 0.3%.
Yeah, but not year on year.
No, well, the growth of the quarter is 0.3. That's down to 1 point. If you actually annualize the way the Americans do, multiply by 4, then you're down to 1.2%, which is a lot lower. Yeah. So I think the slump is starting to strike Australia right now. But the difference between
But it's not a recession. It's not a recession. Still not a recession, though.
Not yet, but I think it will be. I think Australia's had the world's longest running period without a recession. And the reason for it's had the world's longest running housing boom, with the world's longest running credit financing that housing boom. And back to the argument I was making about what actually drives house prices, it's change in new mortgages. The new mortgages determine the price level. Change in new mortgage determine whether the price level rises or falls. And when you look at the data from 1990, which I've done in that blog post, the average increase in new mortgages every year in Australia is running at 0.4% of GDP. Now, that's a lot. When you think about That's the change in mortgage debt, equivalent to 0.5% of GDP every year. That's one hell of a boost, not just to the housing market. It's a boost to the overall economy as well, because the people who borrow that money spend it on people who sell their houses to them and then either upgrade or they go and buy that Lamborghini they were after. What you get is an increase in demand coming out of it, and that's a substantial amount of pedal to the metal, accelerating demand as well. So what you get is in countries like Australia that are doing it, credit demand after the crisis is running at 10 to 15% of GDP. Now in America, it's flatlining at 7%, and Australia is now starting to join the downward trend in credit-based demand, but it's going to be falling from a much higher point than America would do at the moment. And that's the trick. You have a crisis when you have high credit demand going to negative credit demand. America's going to have low credit demand going to negative credit demand, so it'll have a bit of a slump. But Australia's the one that's going to have the real crisis. And
out of those variables that you gave, I mean, we've been talking about debt to GDP ratio, household debt to GDP ratio. Is there a trigger point at which we can say, well, okay, that's where things start to turn? You mentioned those other variables of unemployment, which I would have thought would have been more a consequence, but the amount of money that's going to the finance sector, can we point and say, well, when debt levels get to this level and so much of the proportion of GDP is now being soaked up by the finance sector, that's the point at which we start to turn? Can that be modelled?
Roughly. I mean, it's going to be a rule of thumb thing, and it's affected by many other factors as well, including the size of the government sector and whether you're running a trade surplus or not. But like in terms of sort of rule of thumb warnings, the ones that my colleague, the American billionaire philanthropist Richard Vague, has identified, he said it's anything over 1.5 times GDP is a debt level, and anything over 10% of demand being credit based. And on that front, the countries that qualify, and of course, if you have more,
let's reel them off. Let's go through them.
Okay. Australia, definitely. Canada, definitely. I'll just actually go through my list.
Canada, who's been lifting their interest rates this year, but then decided to stop because they weren't quite so sure how their economy was progressing. So maybe they should push them up.
Yeah,
quickly.
Belgium is another possibility, but Australia and Canada both have trade deficits.
Yeah.
And from my way of thinking, which of course is different to modern monetary theory on this front, I'm happy to talk more about that at a later stage. That to me, running a trade deficit means you have less cash creation coming out of the export sector. So you're more vulnerable, whereas countries like Belgium with a large trade surplus, the trade surplus can make up for the absence of credit. So far I'd say Australia, Belgium, Canada, China. But China, of course, has got enormous government spending and a trade surplus as well. Yeah.
So doesn't that help? And can't they? They're doing everything they can, aren't they, to try and look after their domestic economy? Can't they just become a bit more insular to get over the problem?
And they can. That's one of the strengths they have. They're using the power of government money creation quite effectively. France, which of course is a fun one right now, because France is just gradually sailing up with an increased level of private debt ever since the euro began, from going from about 130% of GDP to about 180% now. And that permanent credit boost is going to run out at some point. It may be what we're running out right now.
But their GDP ratio is way lower. Debt to GDP ratio is way lower than some of the other problem countries that we've talked about. And they've still
not really. France is about 190% of GDP.
Right.
Australia's 205, Canada's 220, but it's still past that barrier that Richard identified of 150% of GDP.
Right. Well, that's going to hurt Europe if France turns. I mean, they still have GDP growth right now. I mean, but they are, they are rioting in the streets over fuel taxes. So there's certainly discontent amongst the people. That's for sure.
Okay, Hong Kong, which is just off the scale, but Hong Kong is very much an entrepreneur city, and it's very hard to work out whether it's being used for money laundering by Chinese corporations or not. But Hong Kong's debt level is over 250% of GDP, and credit is running at about 30% of GDP. So it's ripe for a fall. Then you have Ireland, and oh my God, the Irish. I mean, what is it about that country?
They've just got out of trouble. Now they're going back in again.
Oh, just unbelievable. I mean, there's just I've even got to increase the scale of my graph to see where they've got to. Yeah.
Well, a hard Brexit's not going to help them either. I mean,
not at all.
And all of these, I guess there are circumstances which can just tip things over the edge, aren't there?
Yeah. So they're at 300% of GDP as a private debt level right now. And credit, my program can't even successfully graph their credit level. It's so ridiculously volatile. But they're from plus 40 to minus 10, but they look like they're ripe for another crisis, which is just what they need, of course. Then Korea is a possibility, though Korea again runs a large trade surplus. Luxembourg is off the scale. I mean, Luxembourg is like about the size of a suburb of Paris, so I wouldn't take its data too seriously, but it's pretty crazy. Malaysia is a possibility, but I don't think so. But Malaysia, it's actually going down. Let's just take a proper look at the scale of Malaysia. Malaysia's just below the 150% mark, so it's toying with being a troubled country in the future.
Right, and we talked about New Zealand, of course.
Yeah, New Zealand definitely
goes the same way as Australia. So is it pretty much the same ballpark as Australia?
Similar. It's 180% of GDP, rising at the moment, and credit running at about 10% of GDP. So it's Norway is another one, right, which has got an extremely high level of private debt and reliance on credit. But again, it runs a trade surplus, which is a bit of a buffer.
Yeah, and it's got a big government sector as well, high taxing big government sector, and the same with Sweden, I'd imagine.
Yeah, and then let's see. That is Singapore's another possibility. Singapore's running at about 180% of GDP as a debt level, and credit running at 10%. So it could be, but again, it's got a large trade surplus.
So you've reeled off a lot of countries there. So, I mean, if they all sort of popped off over the next year or two, what does that mean for the world economy? Presumably there's a fair bit of contagion in all of this because, I mean, the way the markets operate, there's going to be a lack of, take France, for example, that's going to create contagion across the whole of Europe because there's going to be a lot of concern and investment's going to dry up, isn't it?
Yeah, and this is the trouble because you've got, I divided the world in the last book. I divided the world into the walking dead of debt, and that's countries like the UK and the USA and Spain, Portugal, et cetera, they had a debt crisis back in 2008 and are now limping along with low levels of credit demand, but rising levels of private debt. But because of the low levels of credit and the high level they're starting from, they're not going to have much of a boom, so they can't have much of a bust. They're going to go from a moderate recovery to a slump again, particularly as central banks like the Federal Reserve start putting up rates. But the other ones are what are called the zombies to be. And they're the ones that got through the crisis by continuing to borrow money, with the exemplar being China. But the actual, like, genuinely capitalist countries that did the same thing, the exemplars being Australia and Canada, now they're running out of credit-based demand. They're reaching a ceiling level of private debt. We're realizing why, because of the level of banking fraud. In particular, Australia, the credit spigot's been turned completely off by the bank's reaction to being exposed for the, I'd like to use an abusive term like assholes, but this is a family show, so I won't.
Who said this was a family show? It's
good question. Good question.
Singapore's an interesting one because Singapore, I mean, it can't be housing driven because almost everybody in Singapore is living in government owned housing. I just wonder whether, in fact, if we were looking for a way out of all of this, and we've talked about social housing in the past, is that part of the answer? Can you help drive down some of this debt? By making housing more affordable, by the government playing a bigger part in housing provision. I guess that doesn't get rid of the debt. It, in fact, potentially makes things worse in the short term because all of a sudden everyone's got this huge debt and they've got negative equity if you drive prices down. Yeah.
It's certainly possible. I mean, the thing with Singapore is that I expect that its major contribution to debt is not the household sector, but the corporate sector. So, like, just Singapore's, just to do.
So if you've got high debt and you've got high growth, that's fine, isn't it? That if it's because that's productive debt.
There is a limit, though. I mean, Singapore's debt levels right now is 1.7 times GDP. If I look at the household level to see how that actually compares, then household debt is 60% of GDP, which is quite low. So its debt levels mainly with the corporate sector, and that's at least when you have corporate sector borrowing money, that's 120% of GDP in Singapore's case. Then the corporate sector is borrowed predominantly for investment purposes, also for share buybacks, of course, in some parts of the world. But corporate debt I think, is less of a worry than household debt, but it's also more volatile.
Yeah.
And so if you have a turnaround in corporate borrowing in Singapore, then that could give you a credit crunch there. But again, Singapore runs a trade surplus. So, and as you say, it's cutting out any danger of a housing bubble by having a very high level of public ownership of housing.
Yeah, which could be part of the answer. Of course, it's too late to do that now. We should have done that decades ago. But is there anything you can do to try and mitigate the circumstances? Is there anything the governments of that long list of countries can do to try and stop things being as bad as they need to be? And are they? And in answering that, this will be my final question because we're already well over time. Will it actually be as disastrous as you're painting, or will it just be a case of, yes, it's going to be tough for maybe a decade, but it's not going to, as Australia hasn't plunged itself into recession yet. You say it will, but what if it just experiences a slight slowdown but doesn't get into negative figures?
I think it'll get into negative figures. But what the government response will be in that case is a massive increase in government spending. Now that's the only thing that stops these being deep slumps. As we began talking about why was the Great Depression far worse than today, it's because the government sector is that much larger now. And when there's a downturn in private spending, then the government sector makes up for it. And that will happen in Australia. And of course, that because politicians obsess about running a surplus, that'll be used as a way of castigating the Labor Party, which will be in power by then. And they'll get blamed for causing a recession because of the increase in government spending, which is like blaming cold weather on the air conditioning system turning up. But that is the sort of logic, unfortunately, we're stuck with.
Yeah, an unfortunate circumstance of timing. That would be in Australia's case, absolutely. But the answer would be the New Deal, to build infrastructure, to perhaps not do what Kevin Rudd did, which is to put money into people's bank accounts, which might be gives you a sugar hit, but also in Australia's case, I think almost certainly pushed up imports of flat screen TVs. But the New Deal approach of let's build meaningful infrastructure projects which are going to help us down the track and help employment at the same time.
That is partly what should be necessary. We saw what happened in Australia politically with the disaster of the national broadband network. Maybe if Tony Abbott's not around, it won't be quite so bad next time round. But my way of thinking is we should actually use government money creation capability to write off private debt.
Yeah.
But to do it in such a way that doesn't inspire another housing bubble and that doesn't reward people who were speculators over those who didn't speculate. So I'd use that government money creation to cancel private debt. And this is one of the other points that Richard Vague's work has done. He's commissioned a study into 150 financial crises pretty much over the last 150 years around the world, and looking at them said in every last one, bar one or two, you couldn't grow your way out of it. You couldn't have the GDP growing faster than debt to cause a recovery. Unless you had a huge trade surplus, which was the case of Saudi Arabia. The only way off was to write the debt off.
Write it off fully, or just write some of it off till you reach
parts of it.
Till you reach a sweet spot where, and then that gets over the unfairness element of it, I guess, as well.
Yeah, but don't do it in such a way that it destroys aggregate demand at the same time, which is the other problem.
Yeah.
So when you got into a trap like this, the only way out is to pay the debt down. And you can do it by using the state's capacity to create money to effectively replace credit-based money with fiat-based money. So it is feasible. Whether it'll be done, I simply do not believe it will. I think what's going to happen, and this is why my overall concern about the level of debt comes from this worry that with the level of debt we've got ourselves in now, we won't resolve it. We won't do anything about it to reconcile it until we're faced with an existential crisis, which is what happened last time round, the existential crisis of the threat of the Nazis. At that point, the government threw a fortune into fighting the Second World War. In the UK's case in 1940, the deficit that year, the government deficit was 40% of GDP. Nobody complained about it because if you didn't spend it, you might be speaking German the next week. I made the comment in Germany recently, which went down really well. But that's the danger. With an existential threat, you don't care about fiscal responsibility. You want to mobilize as many real resources as possible to fight that threat. That meant, Spitfires and things like that during during World War II, it'll mean taking on the climate in what we're facing, I think, in the next 10 to 30 years. When we do it, the amount of government spending will be, and rationing of private sector spending as well, will mean that private sector debt levels fall dramatically.
Well, we might be forced into that, but the crises that you're talking about here are going to happen well before we reach the tipping point where we realise that needs to happen. Just here's a crazy thought, and it might be a crazy thought, but just want to leave you with. If we were to have this debt jubilee that you're talking about, so we start to, in effect, give people money to pay off part of their debt, and to make it equitable, we give money to people who don't have a debt at all, so they go and spend for your life. I mean, could we get over the balance of trade issue by saying, but we're not going to give you straightforward currency, we're going to give you money that can only be spent on stuff that's made in this country?
Or you could have it being given as money which can only be used to buy corporate shares. Which is my preferred
option. Okay, so you're investing in this country. Yeah.
And you're trying to democratizing the ownership of capitalism, which shows something which, we pay lip service to this being a democracy, but we know who gets the most votes. And it comes out of the power of money. And what has been done by central banks in the rest of the world is actually enhance the power of those who currently own shares. So QE's caused a massive increase in inequality in America, Europe and the UK when they were already massively unequal to begin with. Yeah. My approach would be to say let's actually increase not the price of shares but the ownership of shares across the economy.
Only problem with that is, of course, when you start to give Mrs. Mum and Dad all that money in their bank account and say you've got to buy shares with this, you know who's going to win from that? Who's going to be the people broking those shares, and
the finance sector will dive in again, which is why you've got to have limits on the. You've got to say the shares can only be used to pay corporate debt down. You need to have a fund in effect being a buffer between that. Otherwise, you're going to get another share market bubble. So there are all sorts of issues. I agree, but unless we reduce the level of private debt, we're going to be caught in a stagnant global economy. And that's the situation I see us approaching globally: stagnation rather than crisis. And then we're going to realize, holy shit, we're in serious trouble with this planet of ours. What do we do? And we don't have the engineers and we don't have the investment necessary to kickstart the process properly.
All right. And that is a conversation for another day. We'll leave it there. We've spoken long enough. Good one, Steve. We'll catch you again very soon.
Okay, Matt. Bye.
Yeah, we just took up the best part of an hour of your life, 50 minutes or so anyway. Look, next time on the Debunking Economics podcast, just how do banks influence the economy? Are we all paying for their risk-taking, and do they take risks because they know we're going to bail them out if they get into trouble? So how do we stop that happening? How do we manage the role of banks in a way that doesn't penalise us all? That is next time on the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie. I'll see you then. Thanks for listening.